What if I told you the government just passed this massive sweeping tax cut that actually shrinks your tax credits?
Right. It sounds totally
It
backwards.
sounds like a total paradox. I
Yeah.
mean, they are giving with one hand and then quietly taking back billions with the other just through like sheer mathematical complexity.
Exactly. The math under the hood is wild.
It really is. Well, welcome to the deep dive, everyone. It is Thursday, March 12th, 2026, and we are just absolutely thrilled to be sitting down with you again to unpack the things that, actually impact your everyday life.
It is so great to be back. And before we get into the hidden mechanics of today's topic, we do just want to take a really brief moment to look at the broader global
It's
context.
to sure.
Just watching the ongoing situation between the USA, Israel, Iran, and just the broader Middle East, we really want to express a universal hope that the world embraces peace rather than going into war. It's a heavy, deeply complex situation, and we're just, reporting on the global backdrop as it stands today. We're really wishing for a peaceful resolution for everyone involved.
100%. Peace is always the ultimate goal.
Hmm.
And keeping our eyes on those global happenings is exactly why we do what we do here.
Exactly.
And, you might have noticed we took a little hiatus recently. We've been digging deep behind the scenes, really revamping our research processes to make this deep dive more interesting,
Much more detail.
right? More detailed, and to help us reach more people all around the world. That's really the reason there hasn't been a new release until today.
Hmm.
But the energy in the studio right now is just fantastic, and we are so ready to go.
We really are. And we also owe a massive thank you to everyone who tuned into our last deep dive.
Oh, wow. Yeah, the response to that was huge.
It was. The discussion we had on granting permanent residency to up to 33,000 temporary foreign workers who are already inside the country, that generated some just incredible feedback. The perspectives you all shared with us were fascinating.
The community engagement was completely off the charts. So please keep imploring your friends, your colleagues to comment, like, and share this deep dive so others can benefit from the topics we're unpacking.
Definitely.
Because our mission here is to dive deep into community issues and happenings around the world, giving you the context you actually need to be truly well-informed.
And in that last edition, we asked you to drop comments or send personal messages to our email with topics or news you wanted us to analyze.
Right.
And based on the just overwhelming volume of suggestions we got from you, we have a highly anticipated topic on the table today.
We really do. We are tackling Canada's middle-class federal tax rate cut. It's officially known as Bill C-4. And just a quick reminder, if you want to suggest our next topic, or if you are looking to advertise your products on the show, reach out to us. Just send a detailed message to deepdive247@gmail.com.
So for today's mission, we are examining a massive stack of sources. I mean, we are looking at government reports, parliamentary budget officer or PBO costing notes, and some really great independent analyses from places like the C.D. Howe Institute.
Yeah, the goal is really to strip away all the political talking points. We want to unpack how this tax cut actually affects different income brackets, the hidden math of tax credits we mentioned, and the rather unusual risks of retroactive laws.
Yeah, the retroactive part is crazy. Because to understand how this tax cut affects your wallet, we first have to understand the timeline, how and when it was rolled out, because the mechanics here are just highly unusual.
Very unusual. So the core change of Bill C-4 is that the lowest federal marginal personal income tax rate is dropping by 1 percentage point.
Right, so let's anchor that with the actual numbers. The 2024 reference rate for that lowest bracket was 15%.
Okay, 15%, got it.
But this new cut took effect mid-year, specifically on July 1st, 2025.
Which is such a weird time to do it.
It is, and because it split the calendar year right in half, the rate for the 2025 tax year is a blended 14.5%. And then for 2026 and onward, it drops to a flat 14%.
Okay, but the timeline is the absolute wild part to me. Think about today's date. It is March 12th, 2026. Bill C-4 just received royal assent today. Like it literally just became law.
Literally today, yes.
Yet the government had employers updating their payroll withholding tables back in July 2025 based on changes that were technically not law at the time.
I know, it's...
I was trying to think of how to picture this. And it's basically like going to a restaurant, right? You sit down, the waiter lets you order, the chef cooks your meal, you eat the entire thing, and then like 9 months later, The chef finally prints the menu with the actual finalized prices.
That analogy captures the administrative reality perfectly. I mean,
Hmm.
the Canada Revenue Agency actually sent out payroll deduction guidance last summer. They recommended employers switch to the updated withholding tables, but they explicitly noted in their own publications that the changes were not law at the time.
That is just wild.
It is, because when you rely on administrative practice over established law, you invite a whole host of classic governance and technical risks.
Well, yeah, I mean, rolling this out before it's actually law feels like an administrative nightmare waiting to happen. You have employers updating these complex payroll systems based on essentially a promise.
Right.
That has to elevate the error rates, right?
Oh, it undeniably elevates error rates in payroll systems. Employers had to scramble to adjust withholdings right in the middle of a calendar year. But beyond just the immediate payroll errors, you introduce the risk of retroactive year-end reconciliation.
What does that mean for the average person?
Well, consider a mixed-income household or maybe a self-employed contractor or someone who relies heavily on investment income. Basically, anyone without a standard T4 payroll withholding.
Right.
They didn't see a dime of that mid-year benefit. They're only going to realize the 2025 benefit now in the spring of 2026 when they finally file their 2025 returns.
Oh, I see.
Yeah, so it creates this massive disconnect in how different taxpayers actually experience the relief.
Okay, so we have this bizarre retroactive rollout. But let's look at who actually gets the money. The government's headline number is plastered everywhere. They claim nearly 22 million Canadians benefit from this.
Yeah, that's the big talking point.
Right. And they're saying it translates to up to $420 per person or $840 for a two-income family.
Well, mathematically, the 22 million figure does align broadly with the scale of Canada's tax filing population, which sits around 31.6 million people.
Okay.
Roughly a third of those filers already owe no federal personal income tax, so you're left with about two-thirds who theoretically could benefit, which brings you right to that 21 or 22 million mark.
Right, theoretically. But I was looking through the C.D. Howe Institute analysis, and that headline number hides a highly technical catch. It's the difference between gross rate savings and net savings.
Yes, this is crucial.
I really want to spend some time here because this was the aha moment of the entire deep dive for me. It all comes down to non-refundable tax credits.
Yeah. The Canadian tax code is a deeply interconnected web. Non-refundable tax credits include vital things like the basic personal amount, medical expenses, or tuition credits.
Right.
And by law, the value of those non-refundable credits is calculated using the lowest federal tax bracket rate.
But why are they linked at all? Like, why not just set the basic personal amount as direct deduction or just set credits at a flat 20%?
Well, it is essentially an equity mechanism. The basic personal amount represents income you can earn completely tax-free.
Okay.
If it were structured as a standard deduction, a billionaire in the top tax bracket would save 33 cents on the dollar, while a minimum wage worker in the lowest bracket would only save 15 cents.
Oh, because they're deducting from their highest bracket.
Exactly. So by converting it to a non-refundable credit that is pegged specifically to the lowest bracket rate, the tax code ensures the billionaire and the minimum wage worker get the exact same dollar value of tax relief from that basic amount. It basically levels the playing field.
Okay, I see the logic there. If that leveling mechanism is pegged at 15%, they both get a 15% discount. But if the government cuts the bottom bracket to 14% to give us a tax break, that universal discount drops to 14% too.
That is the credit offset catch, exactly. The lowest tax rate dropped, so the value of your tax credits dropped right along with it.
It's like a grocery store throwing a massive sale, like 10% off everything in the store.
Yeah.
But when you get to the register, you realize they also devalued your loyalty points by 10%.
That's a great way to put it.
Right. Your final receipt might look exactly the same as it did last week. A tax cut is actually shrinking our tax credits.
And the independent simulations bear that out in really stark terms. Because of this credit erosion, the C.D. Howe Institute estimates that about 28% of tax filers receive absolutely no net savings whatsoever.
28%. That is well over a quarter of all filers who are essentially just treading water.
Exactly. And the Parliamentary Budget Officer's costing notes, they confirm this reality on a macro scale. Over a 5-year window, the PBO calculates the gross revenue loss from the rate cut is nearly $64 billion.
Wow.
However, the government quietly claws back almost $35.7 billion via those lowered tax credits.
That's more than half.
Yes. That brings the net fiscal cost down to roughly $28.24 billion.
They are saving almost $36 billion just through the quiet math of shrinking tax credits. So when we hear the claim that 22 million Canadians benefit, it really just means the tax relief applies broadly to the mechanics of 22 million tax returns.
Right.
It definitely does not mean there are 22 million net winners walking away with more money in their pockets.
Precisely. It is a description of administrative reach. It is not a guarantee of financial benefit.
Okay, so since nearly a third of filers see zero net benefit, we really need to paint a concrete picture of how this plays out for actual families. How do these numbers hit the wallets of different tax brackets?
Let's look at the PBO estimates for various households. Starting at the lower end of the income spectrum, the gains are really marginal. According to the PDO, a low-income single senior might see average savings of just $50 for the entire year.
$50. That is basically one tank of gas, depending on what you drive.
Yeah. But contrast that with a high-income couple with children.
Yeah.
That household could see up to around $750 in savings.
Wait. If this is a middle-class tax cut targeting the lowest bracket, why on earth is the high-income couple getting the absolute maximum benefit?
It comes down to the bucket system of marginal tax brackets. Everyone, regardless of their total wealth, pays the lowest rate on their first chunk of income.
Oh, right.
Right, so for high earners, their first bucket or bracket is completely full, so they get the maximum possible dollar value discount on the entire first bracket. But for lower income earners, their bucket might only be half full.
So they don't get the full discount.
Exactly. Their gains are close to zero because they don't owe much tax to begin with, and whatever small rate cut they do get is immediately offset by the reduction in their non-refundable tax credits.
So the gains rise slowly through the middle class, but then they completely flatten out at the top, since every single high earner maxes out the benefit on their first bracket.
That's exactly it.
But there is a group that just fascinated me in the research stack. The PBO found a bizarre edge case where people actually lose money because of the AMT trap.
Yes, this is a really critical point about tax system interaction risk. The PBO identified that about 19,690 single filers and 19,420 couples will actually end up paying more federal tax because of this legislation.
That is almost 40,000 households paying more money to the CRA because of a tax cut. I mean, how does the math even allow for that?
It happens when the reduced non-refundable credit rate collides with the alternative minimum tax, or AMT, rules.
Okay.
If a taxpayer has unusually large non-refundable credit claims like massive medical bills or high tuition transfers, they rely really heavily on the value of those credits.
Right. They need those credits to lower their bill.
Exactly. And because the rate used to calculate those crucial credits dropped from 15% to 14%, these specific taxpayers lose more in credit value than they gain from the rate cut on their income. The AMT rules catch them, and it pushes them into a worse financial position.
Wow. It's a small group in the grand scheme of things like, well, under 1% of filers, but it is so important analytically.
It proves that beneficiary counts based purely on top-line rate mechanics overstate the net winners, and it introduces a significant policy risk.
For sure.
When you have accidental losers from a policy marketed as universal relief, it invites heavy scrutiny. It usually requires the government to go back in and apply technical remediations to fix the code, which just complicates the system even further.
So let's zoom out from the individual tax returns for a moment. Individuals might be seeing $50 or maybe a few hundred. But when you aggregate that across the entire country, you are injecting $28 billion of net savings into the national economy over 5 years.
That's a lot of money.
It is. And we just fought a massive battle against inflation. Does this restart the inflation fire?
Well, anytime you shift $28 billion, economists scrutinize inflation and consumer spending. But the context of when this is happening is really key. If we look at the Bank of Canada's January 2026 outlook from just a couple of months ago, inflation is currently hovering near their target.
Which is great. We are finally in a somewhat stable place.
We are. And the bank noted that there is actually excess supply in the economy right now, which is roughly offsetting upward cost pressures.
Okay.
So because of that specific macroeconomic backdrop, the inflation risk from this particular tax cut is viewed as quite limited.
So pouring $28 billion back into the economy won't immediately send the price of groceries skyrocketing again.
Unlikely. There is also a structural macroeconomic reason for that, rooted in the nature of our economy. In a small, open economy like Canada's, the fiscal multiplier of a tax cut is actually quite muted.
Meaning the ripple effect is small. Like if I take my $420 in tax savings, go buy a new flat-screen TV, that TV was probably assembled overseas. The money I just spent leaks out of the Canadian economy. The ripple stops.
Import leakages are a massive factor. A significant portion of consumer goods are imported, so the economic boost doesn't stay local. Furthermore, a lot of the aggregate dollar value of this cut goes to higher income households.
Right, the full bucket.
Exactly. Those households have a higher propensity to simply save that extra money rather than spend it, which further dampens the economic multiplier.
And the PBO costing notes also model a very low behavioral response to this cut. They use a metric called the elasticity of taxable income, or ETI, and they peg it at just 0.1.
Yeah, that ETI point one essentially tells us that a small tax cut on the lowest bracket doesn't suddenly inspire millions of people to work drastically longer hours or change their fundamental economic behavior.
Right.
It provides relief, but it doesn't radically alter productivity.
I really want to compare this to history, because we've seen federal tax reforms before. If we look back at the 2015-2016 package, that was also heavily marketed as a middle-class tax cut, but it functioned very differently under the hood.
The targeting was fundamentally different. The 2015-2016 package cut the second income tax bracket, whereas Bill C-4 cuts the first income tax bracket.
And the difference in who actually feels that is huge. A first bracket cut, like what we have now, reaches much further up the income ladder. Because, like we established earlier, literally everyone pays the lowest rate on their first dollars earned.
Right.
If you cut the second bracket, you are entirely excluding the lowest earners from the rate cut, but you are also targeting the relief much more specifically to the actual middle class, rather than giving a discount to the wealthiest filers.
That historical comparison brings up a massive debate highlighted by the OECD insights in our source stack. It is the ongoing debate between broad rate cuts versus targeted refundable tax credits.
The OECD suggests that if a government really wants to engineer affordability for lower-income households, tweaking the bottom statutory rate is a terribly inefficient tool.
The analysis points in the exact opposite direction of broad cuts. The OECD shows that increasing the basic personal amount or using targeted refundable credits actually gets money directly into the hands of low-income households.
Unlike this cut.
Exactly. A broad rate cut, as we've seen, actually erodes their non-refundable credits, rendering the benefit practically invisible for the bottom third of the economy.
It really paints a completely different picture of what affordability measures actually look like when you pull back the curtain. So, bringing all of this incredible research together, what are the core things we need to be watching to assess the long-term impact of this tax system change?
There are three key monitoring variables that senior policymakers, and honestly everyone listening, should keep a close eye on over the next year. Number one is the CRA's reassessment volume for the 2025 returns. Because this was implemented mid-year, we really need to monitor how many non-standard returns end up needing to be reassessed or corrected.
Oh, that will capture the mixed income folks and the self-employed realizing their benefits late.
Exactly. Number two, patterns of payroll under withholding or over withholding. We need to see if the retroactive nature of the mid-year change caused systemic, lingering errors in employer payroll systems across the country.
Makes sense. And the final variable.
Number three is the actual size and composition of that adversely affected group we talked about.
The AMT trap, folks.
Yes, the folks caught in the AMT trap. Will the government step in with technical remediation to ensure nobody is actively penalized by a purported tax cut? That will be a major policy decision point in the coming months.
That is a phenomenal summary of the road ahead. And for everyone listening, this is where we turn it over to you. Please drop your comments in the comment section below. We want to keep this discussion going. Do you fall into the 28% seeing absolutely no net benefit? Are you seeing the $420 on your returns?
We want to hear about it.
We really do. And more importantly, what other topics about happenings in the world and here in Canada do you want us to dive deep into in our next release?
The suggestions you send in dictate the direction of our research, so please keep them coming.
And as you go about your week, we want to leave you with a final thought to mull over. If broad tax rate cuts are heavily neutralized by shrinking tax credits for the bottom third of earners, are we actually engineering real affordability for the middle class? Or are we just creating the illusion of it through complex tax math? Take a look at your next pay stub and see for yourself.
It is a vital question to ask of any policy.
Thank you all so much for joining us. Remember, if you have ideas or want to advertise your products with us, send us a detailed message at deepdive247@gmail.com. Until next time, stay curious and keep diving deep.
Take care, everyone.